Guys, ever wonder about the investment strategies that you can use to potentially beat the market? Well, today's video is going to introduce you to a concept called factor investing and why more investors should use it, especially in times like this where everyone has crowded into the largest mega caps and are likely overweight large cap tech. So let's dive in to demystify these strategies, and stay tuned to the end for a few key ETFs recommendations to simplify your next potential portfolio position. You see, factor investing is a bit like sifting for gold in the vast river of the stock market. It's a strategy that targets stocks with specific characteristics, such as quality, value, momentum, or minimum volatility. Now, let's imagine the stock market as a bustling city, with each building representing a different stock. Some buildings are taller, representing large cap stocks. These skyscrapers might seem appealing, but concentrating too much on them can expose you to risks. Therefore, it's crucial to consider factors like size and concentration risk when you're picking your investments. But here's the kicker. Factor investing isn't rocket science. It's an easily accessible strategy that could help you navigate the city of stocks more efficiently. By targeting companies with sturdy financial foundations, steady earnings growth, and low leverage, you can potentially outperform the market. Factor investing might sound fancy, but in reality, it's a simple and efficient strategy that can help you beat the market. Now, let's delve into the quality factor, a key element that's becoming increasingly important for investors, and especially now. Picture this. The quality factor is like a discerning jeweler, meticulously inspecting each diamond for cut, color, and clarity. Similarly, when we talk about quality stocks, we're looking for strong financial health, low debt, consistent earnings growth, and robust balance sheets. In the current market scenario, these stocks are like the diamonds in the rough, often outshining their peers with their steady performance and resilience, even in times of market uncertainty. They're the marathon runners of the stock world, demonstrating consistent outperformance and an ability to weather market storms. But there's a catch. Like an over-reliance on a single diamond cut, over-concentration in mega-cap stocks can pose a risk. This is where the quality factor comes into play, helping to mitigate the risk of being overly invested in the largest 7 to 10 stocks that everyone knows. By shifting focus towards quality, you can spread your investments across a broader range of stocks, particularly those from large and mid-cap companies. This strategy not only allows you to be a part of the continued rally, but also helps you avoid the potential pitfalls of over-reliance on mega-cap stocks. If you've made it this far, consider giving us a like and subscribe to support our work of helping wise investors. We really appreciate it. By prioritizing the quality factor, you can diversify your portfolio and avoid the pitfalls of over-reliance on mega-cap stocks, and include a broader mix of mid and small caps, all screened for quality financial factors like balance sheet strength and consistent earnings growth. So how can you incorporate the quality factor into your investment strategy? Let's consider some ETFs that focus on this very factor. One such ETF is the iShares MSCI USA Quality Factor ETF, or QUAL for short. This ETF offers exposure to large and mid-cap US stocks with positive fundamentals such as high return on equity, stable earnings growth, and low financial leverage. It's like a treasure chest filled with high-quality diamonds. The beautiful thing about QUAL is that it helps manage exposure and risk within a stock allocation, giving you the opportunity to broaden your investment horizon beyond the mega-cap names. It's the perfect tool for investors seeking to diversify and shift their focus to large and mid-cap companies. Imagine this. QUAL currently holds 126 large cap quality companies. That's a lot of diamonds in your portfolio. But let's not stop there. Have you heard of Vanguard's US Quality Factor ETF, or VFQI? This ETF might not have as large a fan base as some of the big league quality factor ETFs, but it's got a trick up its sleeve. VFQY focuses on quality across all market cap sizes, including mid and small caps. This means it's a great option if you're looking to skew a bit smaller on the market cap, offering an excellent low-cost approach to building a diversified portfolio with a quality factor tilt all in one. The average company size in this ETF is 15 billion, a stark contrast to the over 100 billion you'd find in large cap ETFs. So whether you're considering the iShares MSCI USA Quality Factor ETF or Vanguard's US Quality Factor ETF, you're taking a step towards a more diversified and potentially higher return portfolio. It's like being a master jeweler, selecting only the highest quality diamonds for your collection. But instead of diamonds, you're investing in high-quality companies that have the potential to weather market uncertainties and deliver steady performance. And remember, the quality factor is all about focusing on companies with strong financial health, like low leverage, strong balance sheets, and consistent earnings growth. By investing in an ETF with such companies, you're not just hoping for the best, you're strategically positioning yourself to capture more of the market's upside while protecting against the downside. Whether you choose the iShares MSCI USA Quality Factor ETF or Vanguard's US Quality Factor ETF, you're taking a step towards a more diversified and potentially higher return portfolio. But what about the future? How can you prepare for potential market pullbacks and seize buying opportunities? Market fluctuations are as inevitable as the tides. They ebb and flow, sometimes calm, sometimes stormy. But like a seasoned sailor, a smart investor knows how to navigate these financial waters. Planning is key. It's about identifying those high-quality stocks, the ones that can weather the storm and keep sailing strong. Those stocks that have demonstrated their resilience, their stability, and their profitability time and again. They are the ones you want in your portfolio when the financial seas get choppy. Consider these quality factor ETFs we've discussed. They provide a way to diversify your holdings, to avoid being overly concentrated in a handful of mega-cap stocks. They offer a path towards investing in a broader range of companies, from large and mid-cap stalwarts to small, nimble contenders. And remember, we're riding the wave of a strong economy. Even if there are pullbacks, they can present buying opportunities, chances to expand your holdings in these high-quality names. Keep your eyes on the horizon and your hands steady on the tiller. Factor investing is like selecting the finest diamonds. At first glance, they may all look the same, but with a closer look, you can discern the superior cut, color, and clarity. With factor investing, you can become a master investor, selecting only the best stocks for your portfolio.